Our topic for today is your accounts receivable. So for accounts receivable, we define it as your contractual right to receive cash. However, before we proceed further on your accounts receivable, let's again break down what we need to understand in your accounts receivable. Of course, the very first one that we need to understand is the definition and the recognition of your accounts receivable. After your definition and recognition, of course, our next issue is the measurement of receivables. And then lastly, the presentation. Okay. So our main focus for AR will be definition and or recognition of AR, the measurement and the presentation. Okay. Before we start with accounts receivable per se, let's have a review on the concept of your financial assets. So financial assets is defined under PS 32. And under financial assets PS 32, it gave you an enumeration of your different items of financial assets. So what are the items of financial assets under PAS 32? The first one is known as your cash. The second one is your contractual right to receive cash. And the third one is the equity instrument of another entity. Okay? Cash, contractual right to receive cash, and equity instrument of another entity. So we already covered cash last meeting. Now we are in your contractual right to receive cash. Whenever we talk about your contractual right to receive cash, this is the right to receive cash or other asset from another entity, or this is the right to receive cash and exchange it to another financial asset or liability that it is potentially favorable to the entity. So contractual right to receive cash or other asset from another entity, or to receive cash or exchange financial asset or liability that is potentially favorable to the entity. That is your contractual right. So whenever we say contractual right, that contractual right can either be just an open contract based on a promissory note, based on a loan, or based on a bond. So the contractual right depends whether it is open, it is based on a note, based on a loan, or based on a bond. If that is an open contractual right, generally we call that one as your accounts receivable. If it is evidenced by a note, we call this one as your notes receivable. If loan, we call it as your loans receivable. And if bond, we call it as your bonds investment or your investment in bond, or we call this one as your debt investment. Okay? Before, we can still, we call your bond as bond receivable, but now it is called investment in bond, bonds investment, or debt investment, or investment in debt securities. So those are the terms used. Next, lastly, equity instrument of another entity. So whenever we talk about equity instrument of another entity, we call this one your investment in debt, no, not debt securities, but investment in equity securities or investment in shares, or also known as investment in stocks. Okay, so for today, hopefully we finish all of the receivables, accounts, notes, and loans. Or basically, if we can finish until bonds, then let's strive to finish it until bonds. But therefore, whenever we talk about financial assets, it is composed of the following. We have here cash, next AR, next NR, next LR. And then we also have your investment in debt and then investment in equity. So whenever we talk about audit per lens, we call this audit of financial assets. So we audit every financial asset. So yesterday, we finished cash. For today, we target to finish your contractual right to receive cash. Okay? Having known the idea of your financial assets again, let's start with your accounts receivable. So for accounts receivable, this type of receivable is a contractual right to receive cash, but it is based on an open account. It is based on an open account. So we define accounts receivable is as a contractual right to receive cash, but it is an open account. Now for accounts receivable, as we said, we need to know the recognition. We need to know the recognition. So how do we recognize your accounts receivable? As a general rule, receivable is tied up to your sales. Receivable is tied up to your sales. So all the financial assets now is governed under PFRS 9. Before it is known as PAS 32, PAS 39. It is now amended by PFRS 9. So although we say your accounts receivable is governed under PFRS 9, the recognition is tied up to your sales. And whenever we talk about sales, what standard must come to your mind? It is the standard PFRS 15. This is your revenue from contracts with customers. So generally, your receivable is tied up to your sales. And whenever your receivable is tied up to your sales, we call that receivable as your trade receivable. Trade receivable. So since it is tied up to your sales, then the recognition comes from PFRS 15. Okay. So how do we recognize then under PFRS 15? So the recognition under PFRS 15 is whenever there is already right to the consideration, and that particular right must be unconditional. That particular right must be unconditional. Furthermore, normally, every amount must be reliably estimated so that we can properly recognize it. So once you have the right to consideration and there's no conditions as to that right, and there's no problem as to its estimation, then we can recognize the receivable. So the general entry here is a debit to AR and a credit to sales or a revenue account. Therefore, whenever we talk about recognition of AR, we go back to the standard for your sales, which is your revenue from contract with customers, that is PFRS 15. By the way, additional knowledge, before our revenue is past 18. Past 18 is our revenue. Now it is amended using or with the standard PFRS 15. Therefore, when we recognize your receivables based on your sales, we use PFRS 15. So that is your recognition for your receivables when there is a right to the consideration that is considered unconditional. Since we already know the recognition, our next issue is the measurement. Our next issue is the measurement. So for measurement, always we need to talk about initial measurement and then subsequent measurement. Initial measurement and subsequent measurement. So for initial measurement, now we initially measure AR using PFRS 9. And under PFRS 9, the initial measurement is known as your fair value plus transaction cost. Fair value plus transaction cost. But we said if the AR comes from your sales, we use PFRS 15. And under PFRS 15, the amount is based on your transaction price. Transaction price. Okay? So again, how do we initially measure your AR? If ever it is purely a receivable coming from PFRS 9 and it is not tied up to your sale, we measure it at fair value plus transaction cost. However, if that AR is tied up to your sale, we measure it in accordance with PFRS 15, and that is your transaction price. Now, the question is, how do we account for your transaction price? So generally, for transaction price, you need to determine based on your advanced financial accounting and reporting, your transaction price is determined depending if ever there is a financing component or no financing component. So what do we mean by financing component or no financing component? So whenever we say there is a financing or no financing component, we mean that there is the effect of the present value of cash flows, effect of present value, because you are financing it. So if ever there is a financing component, therefore it means you account for the present value. So you measure this transaction price at present value. However, what is the exception if there is a financing component? What is the exception? So although you will measure it at present value as a general rule, the exception is the if ever it is only due within a year, due within 1 year. What is the rule? There is now non-discounting, and that is for practical expedient. There is non-discounting for practical expedient. What do we mean by this? So it still follows the rules regarding the present value. So whenever we account or we compute for present value factors, we only compute present value if ever it is long term. So if it is short term, meaning it is due within 1 year, you will now you will not discount it. Okay? If due within 1 year, you will not discount it, even if there is a financing component. But what if it is long term? So present value. So we can further divide financing component. Therefore, if it is long term, then present value. If it is short term, meaning it is due within 1 year, then what is our rule? No discounting. Therefore, you measure it at face amount. Okay, I hope we are clear as to the measurement if there is a financing component under PFRS 15. Take note, whenever the AR is only connected to your sales, then you will measure it in accordance with the measurement of PFRS 15. But if that receivable is not connected to the sale, then you will measure it in accordance with the measurement laid down under PFRS 9. Now, we are talking about PFRS 15. So under PFRS 15, we measure it in accordance to its transaction price. But what really is the transaction price? You need to know whether there is a financing component or there's no financing component. If there is a financing component, if it is long-term, we measure it at present value. If it is short-term, meaning it is to be settled within 1 year, then there is no discounting. You measure it at its face amount. Why? Because under PFRS 15, it provides there that if ever it is due within 1 year, you will not discount it for practical expedient purposes. Now, let's go to your no financing component. If ever there is no financing component, the rule here is that you measure it based on the consideration. And what is the consideration? That is normally the face amount. That is normally the face amount. So we're done with your initial measurement. No much problem as to your initial measurement. Your main problem only happens if ever you are accounting it under PFRS 15. But of course, you already understood that if ever it is long term, you need to compute for the present value. If ever it is short term, of course, you measure it at its face amount as a rule. But in cases of theories, we just laid down the rules regarding PFRS 9 and PFRS 15. Next, let's go to your subsequent measurement. Your subsequent measurement is known as your net realizable value. Net realizable value. And under net realizable value, how do we measure your AR? So we have here your AR less your different items of allowances. This is now your AR net. Okay? we need to get for the net amount of AR. And when we talk about net amount of AR, that is AR less your allowances. The next question is, what are the items of allowances? So the following are the items of your allowances. So the first item of allowances is your allowance for sales discount. Next item is your allowance for sales return. Next, we have your allowance for doubtful accounts. Next, we have your allowance for freight charge. Allowance for freight charge. Okay. So the following allowances decreases your AR. So allowance for sales discount, allowance for sales return, allowance for doubtful accounts, and allowance for freight charge. Now, so that we know what amount will we include for these allowances, we will discuss it one by one. Let's start first with your sales discount. Let's start first with your sales discount. Now, for a sales discount, you need to take note whether you are accounting for it using PFRS 15 or you are accounting it using the old GAAP. Okay? So you need to determine whether you are accounting it using the old GAAP or you are accounting it using your PFRS 15. So under old GAAP, what you have learned before is that you can recognize it at gross or at net. But under PFRS 15, the discount is treated as a variable component. The discount is treated as a variable component. Before we proceed further on your PFRS 15 accounting for sales discount, let's start first the accounting of your sales discount under the old GAAP using your gross and your net. So whenever we talk about your discounts can either be trade discount or cash discount. So a trade discount, you already learned before that whenever we talk about your trade discount, it is a discount given for bulk buying. A discount given for bulk buying. But if that is a cash discount, it is a discount given for prompt payment. Furthermore, a trade discount is not recorded in the books, while a cash discount is recorded in the books. A trade discount is not recorded in the books, while a cash discount is recorded in the books. So let's say, for example, you are given the following 20, 10, 215, and 30. This whole item is known as your credit term. This whole item is known as your credit term. While the 2010 here is known as your trade discount, while 2/15 here is known as your cash discount. 15 is the discount period. 15 is the discount period. And the N30 is the due date. So in 2010, 215, and 30, the 2010 will not be recorded, but the 215 can be recorded. Okay? 215 can be recorded. So let's say, for example, you have here 200,000, 20, 10, 215, and 30. So at the initial recognition, you need to remove now the trade discount. So the amount less the trade discount. So if that is 200, you deduct first the 20%. So that's 40K. You still have 160,000. You deduct the next trade discount, 10%. That is 16,000. So you have here 144,000. So you will record your AR and your sales debit. AR credit sales 144,000. So that is how you initially recognize it. That is how you initially recognize it. Take note also that for a trade discount, you apply it simultaneously. You apply first the first discount before applying the next discount. Because if ever you total the three. Therefore, the effect is that you will get the wrong answer. You will get the wrong answer. But again, just remember that in the discounts, whenever we're talking about trade discounts, you do not record it. So you record it already net of the trade. So at the time of recording of the sale, you debit it net of the trade 144,000. Why? Because trade discount is not reflected in the books. It is not reflected in the books. Therefore, at the point of recognition, what we do is we already remove the discount so that the discount will not be reflected on our books. Okay? That's for trade discount. Next, for cash discount, the next type of discount, we're talking about cash discount. That is a discount given for prompt payment. And take note, it is recorded under our books. So whenever we talk about your sales discount that is recorded under our books, there are two methods of accounting for it. So what are those methods? You have your gross and net. So two methods of recording your cash discount. We have your gross and we have your net. So let's have a comparison of your gross and of your net. So at recognition of AR, the gross is that AR is recorded gross of cash discount. AR is recorded gross of cash discount. While in your net, AR is recorded net of cash discount. AR is recorded net of cash discount. So using our example, what is our example? We have here 144,000 AR and sales. And we have here 2% discount. 144,000 and then we have here a 2% discount. So if we are to compute or record it using gross, your entry is a debit to AR and a credit to sales at 144,000. 144,000. How about under your net? Under your net, you will now record it net of the discount. So debit, AR, credit, sales. 141,120. 141,120. So what is the effect? As you can see under your gross, it is already recorded only at the amount, while net, the discount is removed. So how did we get 141,120? That is 144,000 multiplied by 100% less the discount of 2%. So 144,000 multiplied by 98%. So 141,120 at the time of recognition. Next, at the time of taking the discount, under gross, discount is recorded. Under net, discount is not recorded. Why? Because it is already recorded at net initially. So what is our entry here? First, you need to entry the cash amount. That is 141,120. And then you make an entry as to your sales discount. That is the 2%. That is 2,880. And then we have here AR of 144,000. Okay? While in your net, we will not record the discount. We will only record the AR collection. So you remove AR, 144,000, and 141,120 pala. 141,120 and cash of 141,120. So as you can see, there is a discount here. Here, there is no discount. Why? Because initially, guys, if you try to look at it, you have already recorded it at net. Therefore, since you recorded it at net, then you don't need to recognize the amount of the discount. But also take note of this, regardless of method, whether gross or net, cash collection must be the same. Okay? Regardless of method, cash collection must be the same. So look at this one. Cash here is 141,120. Cash here is 141,120. So it is equal regardless of method. Saan lang sila nagkaiba? Sa amount ng AR na clinedit. Kasi nga dun sa gross, ni-record natin initially at gross. Sa net, ni-record natin siya at net. Kaya yung difference ng cash at saka ng AR sa gross is known as your sales discount. I'll just take note again here. The difference of cash and the AR is known as your sales discount. So since cash is not equal to your AR under gross method, it is known as your sales discount. What if it is not taken? Okay? What if it is not taken? What is our entry? Or what is the effect? So whenever it is not taken, no effect on our books, no effect on our books. So you will just recognize cash, AR, 144,000. As to your net method, there is an effect on our books. Why? Ano namang problema dito? Yung cash naman dito, yun ang hindi equal sa AR natin. Why? Because the cash collection here is 144,000, right? And the AR under net is only 141,120. So ano nangyari doon sa ating 2,880? We call that one as your sales discount forfeited. So under net, whenever the cash is not equal to the AR, we call it your sales discount forfeited. Okay? Sales discount forfeited. Take note of the difference. Take note of the difference. But what I want you to remember here, guys, is that regardless of the method, the cash collection will always be the same. So look again here. Look again here. Your cash is 144 under gross. Your cash under net is also 144. So it is equal, right? Since it is equal, in short, if ever there is a difference on the initial AR recorded, we need to look at it. We need to look at it. And the difference only happens whenever, for gross method, whenever discount is taken, and for net, whenever discount is not taken. Okay, let's wrap up your sales discount under your old GAAP. So under sales discount, we have here your old GAAP or your old standard, which is your past 18. So we have two types of discount. We have here your trade, and then we have here your cash. For trade discount, this is not recorded. Cash discount, it is recorded. And in a cash discount, there are two methods of accounting. So what are the two methods of accounting for a cash discount? The first one is your gross method, and the second one is your net. So your main issue is at the time of recognition. You recognize the AR under gross at the amount of your AR. While for net, it is AR less the discount. So at gross, it is recorded at gross. At net, it is recorded at net. So what if the cash received is not equal to your AR? What if the cash received is not equal to your AR? In gross, that happens only whenever discount is taken. Okay? It happens only whenever discount is taken. But for net method, the cash is not equal to AR whenever discount is not taken. Whenever discount is not taken. And here, what you will do whenever discount is taken, you debit sales discount. Here, you credit sales discount forfeited. So what is the effect of a sales discount? Sales discount decreases your sales. Sales discount decreases your sales, while sales discount forfeited increases your sales. Whenever an item, again, decreases your normal item, we call that as a contra account. And whenever it increases your another item, we call that as your adjunct account. Okay? That is for your old GAAP. So you need to just look as to the type of discount, whether it is trade or a cash discount. And always remember, whatever is the method of recording, whether it is net or gross, always remember the cash is the same. San lang sila magkakaiba? Ang cash na na-receive versus the AR na na-record. Kung ang cash na na-receive at AR na na-record ay magkaiba under gross method, what is the effect? Discount is taken. So under gross method, we call that discount is taken. How about for net method? When is it that your your AR is different from your cash received? Whenever discount is not taken. And what do we do? For gross, we debit sales discount if ever there is a difference. And for net, we credit sales discount forfeited. Okay? That's for your old GAAP under PFR, under PAS 18. Although this question or this concept, still lumalabas naman siya. Still lumalabas siya. Now, let's go to another one for your sales discount. That is your PFRS 15. That is your PFRS 15. So under PFRS 15, it is treated as a variable component. Okay, so whenever we say variable component, it is any variable item that affects the consideration. Therefore, in recording, they still remember, in PFRS 15, we measure it at the amount of the consideration. We measure it at the amount of the consideration. Therefore, if the sales discount is considered as a variable component, how do we record it? So we need to get for the price itself, and then you remove the amount of discount. We remove the amount of discount. So that will be the amount of your AR. So what is the discount here? Discount is recorded as the amount of the consideration less the estimate discount. Less the estimate discount. So in PFRS 15, therefore, if there is a discount, you need to remove it. So for example, you have a sales of 300,000 and then the discount is 2%. And the percentage of who will take the discount is 70%. How much is the amount of our AR? So under PFRS 15, we said you remove now the discount and you estimate it based on the probability. Based on the probability. So how do we recognize then the AR? So it's equal to your sale, 300,000, less the discount estimate. The discount estimate is the price multiplied by the discount multiplied by the estimated discount percent who will take it, which is 70%. So to answer that, that is 300,000 times 2% times 70%, we have here 4,200. So our AR will be recorded at 295,800. That if in case it is based on PFRS 15. Based on PFRS 15. Okay, so this is our outline for sales discount. You need to determine whether it's still old GAAP or you are using PFRS 15. Under old GAAP, you need to recognize whether there is a trade discount or a cash discount. But take note, only cash discount is recorded under two methods. It's either gross or net method. Under PFRS 15, if you are to recognize the amount of the receivable or the amount of the sales revenue, you treat the sales discount as a variable component. That variable component will decrease the amount of our price. So price less the discount. So how do we compute for the discount? The discount is computed this way. You get for the amount of the sale, you multiply it to the amount of the discount and the percent or the estimate of persons who will take the discount. So you just need to multiply that. And after that, that is now your AR. That is now your AR. So that is for our sales discount. So take note, again, we're talking about your net realizable value. And under net realizable value, we have here your AR, less allowance for sales discount, less allowance for sales return, less allowance for doubtful accounts, less allowance for freight charge. We're done with allowance for sales discount. So our next is your allowance for sales return. Our next is allowance for sales return. So let's continue with allowance for sales return. Allowance for sales return. So in your allowance for sales return, generally, this is the return of the inventory. Return of the inventory. So take note, whenever you return the inventory under past 18 before, you will only recognize upon return. But if you can reliably estimate it, then you get the percentage. Okay? Get the percentage. That is under past 18. Now, we are under PFRS 15. Under PFRS 15. So under PFRS 15, how do we account for it? Under PFRS 15, we account whether we can estimate the return, right? Whether we can estimate the return or we cannot estimate. If you can estimate, then we can recognize a revenue. If you cannot estimate, then you cannot recognize revenue. So there is revenue if you can estimate, and if you cannot estimate, no revenue. So before, you just recognize AR and you recognize sales. So under PFRS 15, you need to determine whether you can estimate the return. If you can estimate the return, then you can recognize AR and sales. But if you cannot recognize it, there will be no AR and there will be no sale. So everything starts with your estimation of the return. Why? Because you need to measure reliably what is to be recognized. Always remember, some of the recognition concept is that it must first be probable and it is measurable. So if you cannot estimate it really, therefore, there is a problem as to the measurement of that revenue, then you cannot recognize it. So if you cannot estimate, no revenue, no AR, no sales. If you can estimate it, there is revenue, there is AR, and there is sales. Now, what happens then if you can recognize? If you can recognize, the following must be recorded in your books. The first one is the refund liability for the percentage of returns. For the percentage of returns. And then you will also recognize an asset or a contract asset that is for the percentage of asset or item sold to be returned. Okay. So what is the general entry? Whenever there is a sale, the normal entry is this way, assuming it is perpetual. Assuming it is perpetual, your entry is a debit to AR and a credit to sale. And then you will make a corollary entry that is to debit cost of sale and credit merchandise inventory. So where will the refund liability come from? It comes from the percentage of returns on the sale, while the contract asset comes from the percentage of merchandise inventory to be returned. Therefore, under PFRS 15, with a sales return, normally we call this one as right to return, So under PFRS 15, your entry will now be a debit to AR, a credit to sale, and a credit to a refund liability. Okay. While for cost of sales, your entry will now be cost of sales. And then you have here contract asset. And then you have here your merchandise inventory. Right? Merchandise inventory. So in short, guys, what does PFRS 15 wants you to do? This is what PFRS 15 wants you to do. So whenever you have an AR, you account it for the amount of your sale and the amount of the possible returns or your refunds. So the amount estimated for the sale and the amount estimated for returns or refund. Next, for the merchandise inventory, you will just recognize an item for the cost of sale, for the estimated amount to be sold, and the contract asset for the estimated, again, amount to be returned. Okay? So basically, you recognize an item for the balance sheet and an item for the income statement. So for AR, what is the income statement? The sale. The balance sheet is the returns or refunds. For merchandise inventory, the income statement is the cost of sales, while the balance sheet is the contract asset. So if in case there is a right to return under PFRS 15 or right of return or right for return, then you just need to recognize the following. Aside from recognizing your normal entry, you will have a refund liability for the sale, and for the cost of sales, you will have a contract asset. What is the refund liability? Refund liability is the, again, amount to be refunded or returned if in case there was a return of that asset. If not, then we have no refund liability. So let's wrap up allowance for sales return. For sales return, as long as you reliably estimate it, you provide an allowance. If not, then you only recognize upon return. But you always recognize revenue. Here, past 18, wala tayong problema. Kailangan nyo laging i-recognize yung revenue. Pero under PFRS 15, you need to know whether you can estimate the return or not. If you can estimate the return, then you can recognize the sale. If not, then you cannot recognize the sale. So once you can recognize the sale, you will also recognize the following. What else do you recognize? The refund liability for the percentage of returns and the asset or contract asset for the percentage of asset to be returned based on the estimation of return. Based on the estimation of return. So that is for allowance for sales return. Next, we proceed first for allowance for free charge. Allowance for free charge. Okay, so in allowance for free charge, generally, this comes to the basic accounting topic you have learned before in your merchandise inventory. And what is that topic in merchandise inventory? The terms of the freight terms. What are the freight terms again? FOB shipping point, FOB destination. So in the shipping point, who owns the goods? Owner. It is the buyer. In destination, who owns the goods? Seller. When we talk about owner, it is the owner of the goods while it is in transit. While it is in transit. Okay? While it is in transit. So, as your FOB shipping point and destination, this determines who owns the goods while it is in transit. Next, freight charges. For freight charges, we have the so-called freight prepaid and freight collect. Prepaid and freight collect. So in a freight prepaid, this determines who paid the freight cost. Who paid the freight cost. In freight prepaid, it is paid by the seller. In freight collect, it is the buyer. It is the buyer. Again, in freight terms, it determines who own the goods while it is in transit. So assuming the goods are still in transit, who owns them? That is your FOB shipping point and FOB destination. Now, for determination of the payment of the freight cost, that is either freight prepaid or freight collect. For freight prepaid, it is paid by the seller. For freight collect, it is paid by the buyer. So if that is paid by the seller or the buyer and you have your shipping point and destination, that is the only time that we have a problem. So normally we combine the following. So FOB destination, FOB shipping point is combined with freight prepaid. It is also combined by freight collect. We also have FOB destination combined with freight prepaid and combined with freight collect. So first, who is the owner of the goods? Whenever we talk shipping point, it is the buyer. For destination, who is the owner? It is the seller. Now, who actually paid it? For freight prepaid, who actually paid it? It is the seller. For freight collect, who actually paid it? It is the buyer. So whenever, guys, it is a combination of both owner and whenever the owner and who actually paid it is the same entity. So let's say, for example, here, buyer, seller, then you have no problem here. No problem. So where will your problem arise? Your problem arise as to your FOB shipping point, freight prepaid, and FOB destination freight collect. So whenever you paid the owner here is the buyer, but who paid the shipment, it is the seller. So what is the entry here? A debit to your accounts receivable and a credit to cash. That is for the amount of the cost. For FOB destination, who is the owner? Seller. Therefore, the expense is for the seller. So freight out is the entry, but who actually paid it? It is the buyer. So it reduces cash. So FOB shipping point freight prepaid increases AR, while FOB destination freight collect decreases AR. So whenever we talk about an item which decreases AR, what do we call it? It is only your FOB destination freight collect. So where will your allowance for freight charge come from? Therefore, it only comes from one item, the item which decreases AR, and that is FOB destination freight charge. FOB destination freight charge now. Freight collect. Okay, before we proceed further or before we end in your allowance for freight charge, let's review the concepts we have already learned. So we're talking about your AR. For AR, again, our recognition, if ever it is connected to PFRS 9, then you follow PFRS 9. For PFRS 15, then you follow PFRS 15. So you just need to test for the applicable standard. After that, you determine the initial measurement. What is the initial measurement in PFRS 9? Fair value plus transaction cost. In PFRS 15, it is known as the amount of your transaction price. And transaction price differs if there is a financing component or there is no financing component. If there is financing component, then you determine if ever it is short-term or long-term. For short-term, you measure it at face amount. For long-term, you measure it at present value. Why is short-term again measured at face amount? Because again, for practical expedient, if ever it is due within 1 year, you should not discount it. So no discounting for items due within 1 year. But if ever long-term, you measure it at the present value. What if there is no financing component? You measure it at your consideration. Next issue on your accounts receivable is the subsequent measurement. And how do we subsequently measure? It is your net realizable value. And how do we compute for your net realizable value? So AR less allowance for sales discount less allowance for sales return, less allowance for free charge, and allowance for doubtful accounts. Let's start first in your allowance for sales discount. For allowance for sales discount, you need to determine if what is applicable is the old, meaning you are to account for trade or a cash discount. For cash discount, you record it at gross or you record it at net. So initial measurement under gross, you measure the AR at gross, under net, net of discount. And whenever the amount of cash received is not equal to the AR on record, then what do we treat the difference, or how do we treat it under gross? We treat it as a sales discount, meaning it decreases your sales. For net method, if the cash received is not equal to AR on record, we call that your sales discount forfeited. And a sales discount forfeited increases your sales. But if it comes from PFRS 15, you treat it as a variable component, meaning AR will now be recorded net of the discount. Okay, net of the discount. So you must estimate the component. Next item, sales return. So for sales return, you need to determine again whether you are using a PAS 18 or you are using the new standard. So under the old standard, you can recognize the sale and the revenue. You can recognize the sale and the revenue. Under PFRS 15, you need to determine whether the amount of your return can be estimated. So can it be estimated? If your answer is yes, you recognize AR, you recognize sale. If your answer is no, you don't recognize AR, you don't recognize sale. So in recognition of your AR and sale, we do the following. So in your AR, the amount of your AR will be divided as a portion of your sale and a refund liability. And the corollary entry as a merchandise inventory, an item of cost of sale, and an item of your contract asset. Lastly, allowance for freight charge. You just need to determine, again, if ever we are talking about your freight terms, such as shipping point or destination, or freight charges. That is either collect or prepaid. And take note, we said there are only two items that affect AR. Two items that affect AR. And what are those items? Again, we have here your FOB shipping point. That is your seller. That is, it is owned by your buyer. And who paid it? Freight prepaid. So what is the effect? This increases AR. Next, we have here FOB destination owned by the seller. However, freight collect paid by the buyer. So what is the effect? It decreases your AR. So whenever we talk about the item which decreases the AR, it is your FOB destination freight collect. FOB destination freight collect. Okay? So we stop there first, and then on our next session, we continue with AFDA.